Hello and welcome to another Student Loan Planner podcast. Today we're going to preview a place that I'm going to be taking us in a lot more in the coming weeks and months. So specifically, we're going to talk about investing for student loan borrowers, but without any any particular pitch involved with it. I just want to get you thinking about different things that student loan borrowers have to think about that other people don't when it comes to growing wealth. And the Student Loan Planner podcast, kind of what I'm thinking about for the future, is to do a show where we keep the traditional format of our Tuesdays being a little bit more student loan centric, and then maybe eventually being able to get up to 2 a week where we're doing maybe like financially free Fridays where we talk about maybe just wealth growth topics more generally speaking. That way we have some stuff that could apply to you after your student loans are forgiven. Hot dog, yay. So that would be the dream, right? So today I would talk about specifically IDR sensitive investing and IDR sensitive portfolios. And this is something that I think is really interesting, and I've really never seen this talked about really anywhere, which makes sense because people don't specialize in student loan borrowers really except for us and maybe a few other places in the country. So the big introduction to this is I want you to think about a high income scenario first. So let's say you're a physician in California. Let's say that you are really excited about your 5% high yield savings account. Okay. And let's say you're pursuing PSLF. Let's say you're a surgeon. Maybe you're making $400,000 a year. So you might think, this is amazing. Oh my gosh, how wonderful. 5% yield. But what are you actually earning? What are you actually earning? So let's think about this. So a physician making $400K a year in California would be paying 35% federal, 10% state, about 4% for ACA tax, and then 10% for their IDR payments. It's in total, if you sum all those up, it's about 60%. So if you have 5% yield on your high yield savings account, you are taking home as a high income California physician 2%. 2%. The government's getting 3, you're getting 2. Hopefully I have your attention. Now you might say, well, I don't make that much. How does this really apply to me? Well, it's still actually pretty bad if you are simply if you're making a lot less. So let's do an example. Let's pretend you're a physical therapist making $70,000 a year. Let's say in California as well. I don't know, just to pick on California, but you could do the same analysis for Georgia. Let's say Georgia instead. So physical therapist, 70K, really underpaid at 70K, by the way, because really you should be making 80 to 100K, hopefully, because you deserve that. But anyways, so let's just pretend you're making 70K. So what tax bracket are you in? What's the setup there, right? So 22% federal, 5% state, 10% IDR. So it's 37%. To make the math easy, let's round up to 40. So if you have a high yield savings account earning 5, you're only taking home 3. So this is not just a high income problem. This is a universal student loan borrower problem. Now, think about something like capital gains and dividends. You might think, well, capital gains and dividends, that's not that big of a deal, right? And if you're very low income, it's correct. It's not that big of a deal because your capital gains rate would be 0 if your taxable income is below that 22% bracket. But I want you to think about something for a moment. Think about how capital gains might be 15%, but it's still income. So you're losing 10% for IDR on your capital gains. So instead of a 15% capital gains rate, it's actually 25 if you're a student loan borrower, which is like, what is that, like, 50% higher, something like that? More than that, actually, 60% higher. So that's like really big deal, right? And throw in state income taxes as well. Oh my gosh, investing is totally different for student loan borrowers. And the big reason is, while you have student loans, you are getting hit with a much worse tax bite than other people. So the tax drag of your portfolio is much more significant than for other folks. So, we have an investing course. Some of you all have heard me pitch it on the podcast and stuff. It's a great course. We get good feedback on it. It suggests an allocation of 50-50 US and international for investing. 50% in VTSAX, which is the total US market index fund, 50% into VTIAX, which is Vanguard's total international index fund. Why do I do that? Why do I say that? It works. It's sort of quote unquote good enough, and it's simple. It's easy to remember. It helps people get started, and it makes investing, not too complicated so that people just sit on the sidelines and do nothing, which is much worse than inefficiently paying extra taxes. But think about that portfolio. So every year, I put some numbers together. So if that person that's making, the $70,000 a year physical therapist, so they're losing about almost 3/4 of 1% every year lost to taxes if they're doing that 50-50 portfolio. So that's a really big loss, right? 50%, 50-50 U.S. international to be losing 0.75% to taxes instead of a dividend yield to 2.3, which is the weighted average dividend yield of that portfolio as the time I recorded it. It's about 1.57. So that's like a massive quote unquote AUM fee that all these social media influencers tell you is the worst thing ever, right? So that's like a lot of people are paying a massive quote unquote AUM fee and they don't even realize it. Did you know that you're paying a 2 to 3% AUM fee on your high yield savings account and it's going to the government? A lot of people don't realize that. A lot of people don't think about that, right? Now, interest income is very tax inefficient as a student loan borrower. So one answer is to be thinking about tax-free interest for like municipal bonds, municipal money market funds, for example. In particular, if you're in a high income tax state, there's even state-specific ones that are tax-free at the state level. So there's a lot of different ways to think about this, but the big thing I want folks to realize is student loan borrowers have to care about tax efficiency. And it's not just the tax drag of the ongoing investment. So let me explain that. There's two types of ways that you can get taxed on something. One way is you're taxed on current income in a brokerage account or a savings account, right? So you're taxed on current income. That means like current dividends, current capital gains, current interest, right? But capital gains are only taxed when you sell it, or if you have a inefficient mutual fund or something that's distributing capital gains. So a lot of people don't know this, but if you have like an active mutual fund, like the healthcare fund at Vanguard, for example, very often that fund distributes capital gains from the mutual fund. You didn't even sell anything and you are getting hit with capital gains. Ouch. Sometimes corporate events can happen and a stock can like create capital gains itself. So an example of this from a few years back was Pfizer stock. I think Pfizer did some sort of corporate, maneuver or something that caused, essentially everyone's capital gains that hadn't been taxed yet to be taxed. And so when you have a tax drag on the portfolio, let's say it's about 0.75%. But if you also have a big gain on something and something happens, right? Or you just go sell it, that's a huge tax drag too. So let's think about a scenario where you put $10,000 in the S&P 500 and it doubles, so it's $20,000. So you have to pay tax on that $10,000 gain, right? Well, how much? Well, let's say you earn less than $100,000. Well, it's 15% capital gains, 10% IDR, probably 5% state, so it's 30%. So you're losing $3,000 out of that $10,000 gain. So of the entire investment that you have, the $20,000 investment, you are losing $3,000 to taxes. That is a lot. That's 15% of the total investment. And if you split that in an equal amount over 10 years, that's like a tax drag of 1.5% a year. So throw on the tax drag from your loss of taxes to dividend income of 0.75%, and throw on a 1.5% drag from, the annualized equivalent of what happens when you go and sell it. And that would be like a 2.25% AUM fee to taxes every year. Then there's ways to make, you can't avoid taxes completely. Anybody who tells you can avoid taxes completely is probably selling some sort of passive, income scam or something like that. You can, I guess, avoid taxes completely, maybe in some very rare scenarios, but it's very, very difficult. And a lot of times people get a lot more focused on the tax part of things than the actual after-tax investment returns, which is what actually matters. Right? So remember, after-tax investment performance is what matters, not how much or little in taxes you pay. So you're just trying to optimize for that after-tax yield and performance. And so, when I'm thinking about, the impact of taxes over time, how do you minimize that? Well, one way to minimize the hit of future capital gains when you go sell is things like tax loss harvesting. So tax loss harvesting, what is that? That's when you take a fund that is similar but not identical and, swap them when there's a loss, wait 30 days, swap back. So an example of this, let's say you put that $10,000 investment in the 500 index fund, wait 30 days, let's say it went down 30%. So you swap the $7,000 that it's currently worth into something similar but not identical. So the S&P 500 and the total U.S. index fund are similar but not identical. The performance is almost like 98%, 99% correlated, but it's not the same index. So that counts. You can do that. So you swap your 7,000, 500 index into the total stock market, wait 30 days, swap back. So let's just say, for making it simple, that the price of the investment didn't change in those 30 days. So what you did is you captured a $3,000 loss doing that. Now, if you do that over a long period of time on much larger amounts of money, you will build up a lot larger losses, and you won't be able to claim all of those because you can only claim up to $3,000 a year against your active income unless you have capital gains, in which case, you can offset the capital gains against those paper losses. So I personally have 6 figures of carry forward losses. That is to help me in the future if, for example, I were ever to sell my home for a gain more than $500,000, because the first $500,000 is tax-free. If I was ever to sell a business, like for example, student loan planner, if I ever sold it, then I could offset, gains against those paper losses that I've accumulated. So that's avoiding taxes in the future. That is future tax investment planning. So it's not just like, how are you doing today? It's like, how will you be doing long term? What are you doing now that's going to help you in the future? What are you doing now that's going to offset the sale that you make to fund the down payment on your vacation home? And will you be saving on taxes because of what you did along the way? Remember, for student loan borrowers, it's a much bigger deal because you're losing 10% extra to taxes compared to everybody else if you're on an IDR plan. So, if I'm thinking of, the tax loss harvesting bit, that is a way that you could potentially offset a portion or all of the capital gains that you incur, depending on how careful you are about it. And then if you pair something like tax loss harvesting with donation of shares, if you're charitably inclined, this can be a super powerful approach. Why do I say that? Well, think about this. Say you're generating those paper losses. What's going to happen is you're going to be getting more and more gains on certain parts of your portfolio, right? And some of your portfolio will have huge gains on them because you're continually doing this tax loss harvesting to get, more and more paper losses, right? So what you can do is you can use a donor advised fund, like something called DAFI is what I use. And what you can do is you can donate the part of your portfolio that's gone up in price the most. So you can donate, like, let's say you've got an asset that's up 80%. So I had one of these kind of ETF holdings that I invested in at like the bottom of the market crash during the pandemic, and it was worth a ton, right? Compared to the other parts of my portfolio. So I specifically designated via my donor advised fund, hey, I want you to donate this part of my stock that has the biggest gain. And what that does is it helps me get that gain out of my portfolio where it's never taxed. And I get the full value of the investment as a write-off against my active taxes if I'm itemizing. And by the way, most people in the future are going to be itemizing because interest rates are so high. So your interest in your first $750K of mortgage principal is tax deductible. So back in the day when people had, 3% mortgages, you might be incurring $15,000 in mortgage interest a year, and the standard deduction is like $28,000, and you're capped at taking $10K of state and local property taxes as an itemized write-off. So, $15K mortgage interest, $10K state and local tax write-off caps, that's $25,000, standard deductions $28,000. So a bunch of people were not itemizing, but in this new higher mortgage rates world, way more people are itemizing, right? And so the benefit of this donor advised fund strategy of getting the gains out of your portfolio, tax loss harvesting along the way to minimize that like after the fact tax bite, which is like the phantom AUM fee of like what happens when you eventually sell your investments. And, a lot of big mistakes that student loan borrowers make too is not taking advantage of the pre-tax accounts that well. So they hear on some sort of popular radio show or podcast, Roths are wonderful. Roths are so good. And it's usually laced with some sort of like political kind of, bent, like, the government's evil, don't give the government your money. Roths are great because you never pay taxes again. I mean, they're just trying to be polemical and interesting so that it feeds the algorithm, right? That's a whole lot of personal finance content is built for algorithms instead of humans. And I'm not very good at going viral, I guess, but I at least try to make stuff that's useful, which is my goal, right, for you. So the thing to think about when it comes to those pre-tax accounts is student loan borrowers are almost always better off doing pre-tax in every scenario instead of Roth. And the Roth backdoor is something that you can't do a pre-tax contribution on a traditional IRA once you're, if you have a retirement plan through work or you're making too much money and stuff. So back to Roth, that's fine. But I'm talking about like traditional pre-tax 401k, 403b, 457 kind of stuff, solo 401k, etc. You want to try to go pre-tax on that if you absolutely can. So why is that? Well, remember that situation where we're looking at the, even a modest income student loan borrower is probably in a 40% tax bracket. So if you look at 40%, so when your student loans are gone and there's a greater than non-zero chance that you won't be living in New York or California in retirement, it's still possible, but a lot of those states also, some of those states exempt certain types of retirement income distributions from state income taxes as an incentive to try to get retirees to stay in the states, right? So there's like just a ton, there's a ton of reasons why it makes a lot more sense to put that money into pre-tax instead of after-tax or Roth first for student loan borrowers. So those are some of the things to really think about, identifying the shares that you sell when you sell them. So in addition to the tax loss harvesting, when you go and sell something, you can do what your brokerage account suggests, right? Which is, think about this like your servicer. You call your servicer, they say, what plan should I be on? They say, oh, it's the same plan. It's the best for everyone. Just choose that one. Oh, definitely. Tell us what your IRS income info is and share it with us automatically. And then they say a bunch of stuff. It's one size fits all. And a lot of times it's extremely damaging, such as when you needed to cut your payment off at 20 years instead of 25 years. And so you'd be better off on the pay or the new IBR plan instead of the 25-year save plan, for example, right? The same thing is true when you're investing at one of these DIY places and you turn around and sell some stuff. So for example, if you go turn around and sell some stuff at a brokerage account, like a Vanguard or Fidelity or Schwab, they're going to probably use average cost is the method that when you sell something, and that is going to take all your gains and use the pro rata gain as your cost reporting. And that's could be very, very expensive. Instead you could pick the stuff that's got the lowest gain and then pay a lot less in taxes that way. Pairing that with tax loss harvesting, you might take away that gain situation. So the example I think I mentioned earlier was, you've got two investments made at different times. Each of them are 10K each, but the earlier investment's worth 20. The investment you just made is 10K and it's still worth 10K. And you turn around and you sell half of it. So you sell $10,000, right? So the average cost method is going to say, you've got a $30,000 total investment. You've got $20,000 of cost basis. You're selling $10,000, so the pro rata gain there is about $3,300. And then if you're in a 30% tax bracket, you're losing about $1,200 or so to tax. And instead, what you could do with a different method of reporting your sale is you could tell your brokerage company instead, hey, I want to pick the investment that I sell, so I'm going to sell the second one. I'm going to sell the one that's $10,000 that I just bought, and there's no gain on that, right? So since there's no gain, you would not incur any tax loss harvesting need. And so instead of having a drag of 1 or 1.5% on your portfolio over a 10-year period from this like capital gain that you took, instead it's not there at all. It's not a problem at all because you didn't incur it, because you did specific identification of shares. So this concept of IDR sensitive investing, part of it is taxes, and part of this needs to last and live on well beyond you having student loan debt. And then a part of it is aware of you having tons of taxes right now on your student loans. So this is like, it's really, I think, pretty profound concept. But it's not just taxes that matters when thinking about IDR sensitive investing. The other thing that I wanted to caution folks about is overconfidence bias and behavioral mistakes. And so what I mean by that is, our folks that listen to this, and this probably applies to you as well, you are definitely applies to you if you're listening to this, if you made it this far in the podcast, because this is some technical stuff. You are very smart. You are very, very smart. Your knowledge and your training and just your awareness of things is way higher than the average person, right? And what that means is you are way more subject to overconfidence bias, or way more at risk of overconfidence bias than you realize, right? And I hesitate to use the word arrogance, but we're all a little bit arrogant. Especially the higher your IQ, it seems, the more arrogant you get, right? And sometimes, that's maybe there may be some truth in that, right? If you have an advanced degree, yeah, like you're very smart. Like, could you do this on your own? Yeah, you probably could. But the thing is nobody's going to be showing you how much are you paying in taxes, how much of a indirect AUM fee did you pay because you were not paying attention to the drag in your portfolio. What things do you not know? Like the difference between qualified dividends and non-qualified dividends. I would bet that a lot of people on this podcast have investments in the Total International Stock Market Index Fund. And I would bet maybe 10% of those people that have those investments understand the tax differences between a qualified dividend and a non-qualified dividend, and knew that the Total International Index Fund had about a third of its dividends that were taxed at ordinary income rates. I bet you folks didn't even realize that the International Index Fund yielded almost triple the yield of the S&P 500 and therefore has a much worse tax drag, right? I would bet maybe at least 75% of people don't know that the default method of selling stocks at brokerage accounts incurs needless capital gains that is easily equivalent to a 1 or 1.5% drag on a portfolio's performance for a lot of people. And in fact, if you have a big gain over a short period of time, the AUM fee could be 5%, 10% AUM fee. I mean, like depending on how short the holding period is, right? Because that drag in the portfolio is lower the longer you held the investment, if that makes sense. So I think that, there's something called the Lake Wobegon effect, where all of the children are above average, all of the men and women are above average looking, and all of the houses are above average or something like that. And it's sort of a joke because everyone thinks they're above average, but when it comes to investing, it's statistically impossible, right? Because if everybody was above average, the math doesn't work. So you have an average investment performance. That average investment performance in aggregate is dragged down by things like behavioral mistakes and investment taxes, fees paid, etc. Right? And so if you look at the difference between the return that a fund gets, which is the time-weighted rate of return, and then you look at the money-weighted rate of return, there's often a massive difference. And by the way, time-weighted rate of return is just, you pretend you put $1 in the S&P 500 fund at Vanguard and you hold it for 10 years. That's the time-weighted rate of return. Money-weighted rate of return looks at the money coming in and out of the fund and how did that perform. And so what you see is people chase performance. If growth stocks have done really well compared to value or international over the past 20 years, which it has, people flood money into growth funds. If international does really well, like the Japanese market did in the 80s, people flood money into Japan and say, this time is different. It's going to be a totally different world we're living in now and get ready for it, right? And that's not true. Statistically, mean reversion is undefeated. Now, there are some, couple exceptions in history, but in general, and when I say couple exceptions, essentially, if you lose a world war, your stock market doesn't do well. Those are the lessons from history is don't lose a major war, otherwise your stock market might not recover for a while. But other than that, mean reversion is undefeated. So think about that when it comes to investing, right? It's very easy, like I said, to lose a 1, 2, 3, 4, 5% AUM fee to taxes. And most people have no clue they're paying it because they just pay it at the end of the year and they don't think about it, right? So, IDR sensitive investing, it's something that you can implement on your own by doing things like asset locations. The way we do it for SLP Wealth now, and I'll say this real quick just for legal disclosures, right? SLP Wealth is a registered investment advisor, headquarters in Durham, North Carolina. And I've got to say, I think too, past performance is no guarantee of future results, and this is not personalized recommended investment advice. And then there's no promises of investment performance with these statements. So I guess I have to say that. But what we do with SLP Wealth is instead of doing like the 50-50 US and international, we take the cake, which is the broad market performance, and we add some icing to it and some tax efficiency asset location to it. So the way we do it is we have more of like a 60-40 US and international allocation, just because we think people like home country bias, and that's something we observe in most portfolios. So we do 60-40 instead of 50-50 for one. And then we will tilt in a brokerage account like 70% US and 30% international. Why? Because the dividend yields, remember, US is more tax efficient than international. So we tilt in the brokerage account where it's taxed towards US. And then in retirement, we do 50-50. And the overall allocation we hope is somewhere close to 60-40 for US and international. And then within growth and value, we take our large, broad market index funds like VTSAX, and we split it up into, the growth and value half. So literally, if you take S&P 500, for example, there's 250 stocks you'd classify as growth, and there's 250 you'd classify as value. And that still represents the total broad market. So instead of just holding that one fund, we'll do like 60% growth, 40% value in the brokerage account, and then the retirement account will do 40% growth and 60% value for our broad market exposure. What that does is it gets the whole portfolio to the target allocation that we're trying to do. And then we also overlay a little bit of small cap value, just because we think over the long period of time, if you rebalance that regularly, if you look at long-term risk-adjusted performance in the context of a broad portfolio, we think that that has a decent chance of outperforming just a portfolio of broad market index funds. So we have a little bit of icing on the cake in addition to those asset location things. And so small cap value, actually, interestingly enough, is not as tax inefficient as broad, at least the funds we use are not as tax inefficient as the broad market value index, interestingly enough, because the dividend yield's lower. But, thinking about what does that do for you, right? Depending on your tax bracket, it probably saves you somewhere between 0.05 and 0.2% in performance in your brokerage account and taxes a year. Is that meaningful? In isolation, no, it's not. But remember things like maximizing all those pre-tax accounts, things like tax loss harvesting, things like doing specific identification of shares. If you have to think about it like every ounce matters, right? So when I went on a backpacking trip when I was younger, they did this something called a shakedown. And what you do during a shakedown is you take your pack out and you throw everything in your pack out on the ground on a tarp. And then the experienced, guides, the trail guides, tell you what you get to keep and what you don't get to keep, right? And we thought that this was nuts. Like, we saw guys shaving off their toothbrush handle, and we thought, is that crazy? And then I looked at some people that were really experienced, and he said, trust me, you should do it. And I was like, so what do you mean? And he's like, the only things you've got to have, water is your most vital thing, some high density, caloric snacks, and a lot of food, and then everything else is sort of luxury. And so we took our gear and we got rid of like 2/3 of it, and I cut my pack weight down substantially. And then when we filled it out with a bunch of other stuff, which you could call that like the baggage of life, I'm just kidding, but like, the distractions in life, things that, take your time and energy away from looking at your investments and your financial performance and stuff like that. So essentially what happened is by caring about the shaving off the toothbrush handle when hiking, I, over the course of the 2 weeks that I was on the trail, took so much less impact on my knees, so much less impact on my feet, carried so much less weight cumulatively, that I was one of the only people on the trail that didn't get, horrific blisters and exhaustion. And I was able to hike up the mountain that we hiked up on without having to take a lot of breaks. And it wasn't just because I was in great shape. I was, a teenager. It was better shape than I am now, but it was just, I was in average shape. And so the same thought process applies to investing. If you don't pay attention to taxes, well, you'll be living in ignorant bliss, because you'll have no idea how much you're losing in performance. And meanwhile, you'll be focused on, AUM fees are bad. Well, you're probably paying a 2 to 3% AUM fee and not even realizing it to taxes, right? So that's the ignorant bliss state of investing. And then by paying attention to taxes, but by paying attention to all of it in detail, that's kind of like getting your backpack down to the bare minimum to have really great journey long-term to get you to where you want to be, right? So that's the best analogy I think that I'm capable of giving. If you are interested in this kind of stuff, obviously, not obviously, I guess, SLP Wealth that I mentioned is our registered investment advisor. And we've got, I think we're closing in on, I'll say we have 4 figures of clients now. I'll say that. So we've got a lot of people that trust us to manage finances and invest with us, and we'd love to have you join us. If you're already a consult client, then you can use studentloanplanner.com/discount. So studentloanplanner.com/discount, and you can go through that link and it'll give you the best deal to join SLP Wealth. And if you're not a consult client, you can also use studentloanplanner.com/discount and then answer some questions about, what exactly you're looking for. And it might have you do a discounted student loan consult first before you join SLP Wealth. And we do have occupation-specific groups too. So we have occupation-specific groups for physicians, dentists, veterinarians, lawyers. I'm going to miss some people, but NPs, PAs, and folks in like government, higher ed, teachers, etc. So we're trying to grow those occupation-specific groups. You can certainly join if you're not in those occupations. You'll be working with just our general financial planning team. But as we grow those professions, we're going to get profession-specific groups in each profession, and we'll just move folks that want to move once we have those groups into the profession-specific groups. And the fee, I don't think, can be beaten anywhere. If you go to the studentloanplanner.com/discount, you'll see what I mean. So, by the way, these types of investment strategies, this is why people pay us to manage it for them, right? It's because we're the only folks out there that I'm aware of that are investing specifically with student loan borrowers in mind, with the specific unique challenges that student loan borrowers have, namely losing a lot more of your investment performance to taxes than other people do. So hopefully you've enjoyed this. Again, studentloanplanner.com/discount. If you have any feedback about the show, reach out to us, help@studentloanplanner.com. Really appreciate you for listening to this. This is a little technical, it's a little jargony, but I hope you enjoyed this. I hope that it made sense. If it doesn't, reach out to us and tell me that. But if you want to join SLP Wealth and get this done for you because you just don't want to listen to more technical podcasts about stuff like this, and you just want it to be done for you, then studentloanplanner.com/discount. And again, just all those disclosures. SLP Wealth is a registered investment advisor with the SEC. Thank you, everybody, and have a wonderful rest of your week.